The best time to buy stocks is at regularly timed intervals, and I've shared all the data to back it up in this video. With the market at all-time highs and everybody talking about a pending recession, it can be scary to get into the market right now. There's lots of theories and advice on how you should invest, and there's no shortage of random people on YouTube telling you what to do with your money. But there's really nothing like data to tell you what is the best strategy. If I'm looking to invest my money in the best way possible, I want a strategy that has been proven that it works by the data. And that's why over the weekend, I ran some numbers on some historical stock market data to test 3 different market timing strategies. And yes, that is how I spend my weekends. Using historical stock market returns from 1988 to 2019, I calculated what would have happened to your money in 3 different scenarios. One where you timed the market perfectly and you bought at exactly the right times. And then another where you tried to time the market but you failed miserably and bought at exactly the wrong times. And finally, a scenario where you didn't bother trying to time the market at all and instead you invested at regular intervals the entire time. In the first scenario, you would have bought at exactly the lowest of the lows right after 3 market crashes. The 2000 dot-com bubble bursting in 2000, and then we saw the financial crisis in 2007-2008. And then in 2018, sort of towards the end of the year, we saw a mini crash. So in my spreadsheet, I tested what would have happened if in the first scenario, you would have completely avoided the crash and gotten in right at the bottom. The second scenario, you would have bought right at the top, right before the crash. So you got in at the worst price. And then in the third scenario, you invested at regular intervals the entire time, crash or no crash. And let me tell you, the results are shocking. So the vast majority of people make investing decisions based on emotions, but with this study, now you can be different from everybody else. You're gonna know how to look at data and make investment decisions based on what the numbers say and not what some random person on YouTube tells you what to do. So if you want some data-backed insights on how to handle your investments, given where we are in the market cycle, as well as find out when is the best time to buy stocks, then keep watching. Okay, so here's the lowdown on the study I did. I took the monthly returns of the S&P 500 over a 31-year period from 1988 to 2019. Then I assumed that each investor saved $500 a month every single month for those entire 31 years. In the first scenario, where you had perfect market timing, you would have always waited to buy your stocks right at the very lows of the market after any one of those 3 crashes. The 2000, 2008, and 2018 crash. And whenever you were waiting for that perfect time to buy, you saved up your $500 a month in cash, which would then pile up so you could deploy when it was time to buy. And if you had invested like this, you would have ended up with $1,235,760.10 at the end of those 31 years. In the second scenario, you had horrible market timing. You never got the timing right, so you always ended up buying your stocks at the top of the market, right before it crashed. And if you had invested like this, you would have ended up with $577,532 at the end of those 31 years. And finally, in the third scenario, you had a very different approach from the first 2. So instead of trying to time the market and picking the best times to buy, you just invested on a recurring basis, $500 a month every single month. In other words, you invested like a robot. Every month, you bought the same dollar amount of stocks, whether the market was high or low, crashing or not crashing. This strategy is also known as dollar cost averaging. And if you had invested like this, you would have ended up with $1,183,224.46 at the end of the 31 years. Keep in mind, all 3 of these investors contributed $500 a month, or a total of $192,000 over the course of those 31 years. And they all invested in the same S&P 500 index fund. Same investment, same amount of money that they each put in, 3 very different outcomes. If you want to see for yourself how I came up with these results, you can get my spreadsheet right below the video in the description. So check it out if you want to verify my numbers. Okay, so what can we learn from this? The number one takeaway from this study is that you should definitely smash that like button. All jokes aside, I think there's 3 key takeaways. The first takeaway is that in all 3 scenarios, you ended up with way more money than you started with. In all 3 situations, you contributed $500 a month, or a total of $192,000, and you still ended up with more than you actually put in. What this tells me is that even if you have horrible market timing, it's still better to invest than to not invest. Because if you don't invest and you just save your cash in a bank account, then at the end of those 31 years, you'll just have what you put in, which is the $192,000. Over the long run, the investor always ends up better than the saver. The second takeaway is that if you just forget about trying to time the market and you just make regular purchases instead with a dollar cost averaging strategy, you would have ended up with $1.18 million. You'd be a millionaire. Not too shabby, right? And what's amazing is that the difference between having done a regular dollar cost averaging strategy versus having bought at exactly the best times with perfect market timing is not huge. The person who timed the market perfectly, in other words, in that first scenario, they ended up with $1.235 million. So that's only a difference of $52,000 from the dollar cost averager. And the thing is, it's actually impossible to time the market. I'll show you some very sobering stats on that in just a minute, but given that making consistent investments at regular monthly intervals is something that anyone can do and that it's actually doable, I think that is the best approach. The third takeaway is that a long time horizon is key. Even in the worst case scenario where you always got into the market at the very top, if you had a long time horizon, and the period that I looked at was a 31-year time period, you still ended up with a lot more money than you put in. And in the dollar cost averaging scenario, as well as the best case scenario, you ended up with exponentially more money than you put in. What most people forget to consider is that when you own stocks, you also get dividends that entire time. And then those dividends get reinvested, which helps you buy more shares, which then gets you more dividends, and that gets you more shares. And that is how compounding works. You see the biggest gains at the end of your investment time horizon. That's why having a long time horizon is also key, because you won't really see the full power of compounding until towards the end. Ever heard that quote, "Good things come to those who wait"? Especially when it comes to investing, it is so true. I decided to do this study because I was getting so many questions about whether it's a good time to buy stocks right now or should they wait after a crash. So rather than giving bad advice just based on my own opinions, I decided to do this study on actual data. And after doing this study, I actually personally got such a sense of relief, because rather than stressing about when it's going to be the best time to buy, it's just so much easier to invest like a robot with equal dollar amounts on the same day of every month, rain or shine. And it's so good to know that you'll end up doing really, really well if you just do that. Market timing sounds great in theory, but in reality, you know it's hard to do. We all want to sell high and buy low because that's what's gonna end up making the most money for us. But in reality, doing that goes against human nature. In fact, most people end up doing the exact opposite. When the market crashes, people sell because they're scared. And when the market's doing well, people buy because they want to make money. They end up buying high and selling low. Even if you had psychic abilities and you knew that the stock market had reached the bottom, it takes a lot of guts to buy there. Just think about it. After the last market crash, everyone was talking doom and gloom and financial apocalypse. So in order to actually go in with all your cash into the market at that moment, you have to have nerves of steel. I don't know about you, but that sounds pretty stressful to me. I'd rather have a plan in place right now and not have to make any big decisions when the market's going crazy and it's hard to think straight. And not only is trying to time the market a stressful thing to do, but it's also a game where individual investors like us don't have an edge. There's hedge funds and big banks and institutions with hundreds of millions of dollars behind them. They have top of the line tech and equipment, and even they have a hard time timing the market. In my past life, I used to work on Wall Street as a Forex trader, which is basically day trading. I literally had 5 different computer screens. This setup cost probably about $20,000 a year, but for you, the individual investor sitting at home, while you can do a lot with your iPhone or your laptop, it's really nothing compared to the kinds of tools that the big players have access to. So I really don't think trying to time the market and to buy stocks at the perfect time is really a game that individual investors should try to play. In fact, here are some sobering stats on your likelihood of success if you were to try to time the market. In a study done by Dalbar, a reputable financial data analyzer, they found that for the 30 years ended in 2015, the S&P 500 earned 10.35%, while the average fund investor earned only 3.66%. So why did the average investor earn so much less when the actual market did so much better? Because people jump in and out of the market trying to time it and gain an edge, just hoping to time their investments for the maximum profit. And then the result is that they do worse than they would have done if they had just sat there and done nothing. In another study that was published in the Journal of Financial Economics, they found that among 237 newsletters that sent out market timing investment recommendations, less than 25% of those recommendations turned out to be correct. In fact, one well-known market timing advisor produced a 5.4% loss during a 13-year period when the S&P 500 actually produced an annual return of 15.9%. Pretty eye-opening, right? I'll link to all the studies that I mentioned in this video right below in the description. But hopefully I've shown you enough evidence by now to convince you that you're most likely to be successful at investing when you don't try to time the market. So, what's the verdict? When is the best time to buy stocks? The answer? The best time to buy stocks is at regularly timed intervals. And I've shared all the data to back it up in this video. Just like the imaginary investor in my spreadsheet, in the third scenario, if you invest equal dollar amounts every month, rain or shine, and you just keep buying whether the market's up or down, you'll see great results in your portfolio. When I first started out investing, it was really intimidating for me because I didn't come from a family of investors. And the one time my parents tried investing in the market, they panicked during a crash and sold, and then they lost a lot of money. And unfortunately, I know this happens to a lot of people. So this is a topic that is near and dear to my heart. And it took me a lot of study and research to realize that your biggest enemy when it comes to investing is your own emotions. I've read so many books from all kinds of investing gurus, Warren Buffett, Ray Dalio, David Swenson, Jack Bogle, and they all say the same thing. They say don't try to time the market and don't invest with your emotions. All of them advise you to have a disciplined investing plan, to stick with it, and then just sit back and let the market do its thing. And it actually takes a lot of financial literacy to do that. I'm recording this video in December 2019, so depending on when you're watching it, this could be old information, but as of December 2019, the market has been making record new highs. And ever since the 2008 financial crisis, the stock market has been on this major bull run, the longest one in history. And people keep predicting that it's going to crash soon. But the reality is we actually don't know when that's going to happen. And if interest rates continue to go even lower than they are now, the stock market will probably keep going up. I mean, rates in the US are already low, but they could even go negative as they are in Europe and Japan. So if you're one of those people that are sitting on the sidelines and you're saying that you're not going to start investing until after the crash, well, what if the stock market keeps going up for another 1, 2, 3, 4, 5, X amount of years? It could happen. That is why I'd rather not try to time the market. I'd rather not take any chances and just keep investing consistent, regular amounts using a dollar cost averaging strategy. Okay, by now I've mentioned dollar cost averaging about 50 times in this video. So if you're curious about it and you want to learn more about how dollar cost averaging works, and why it works, and also how to actually do it, then make sure you subscribe to my channel and hit that notification bell, because I'll be talking all about dollar cost averaging in my next video. I post new money and investing videos every Wednesday, so I'll see you next week, same time, same place. As always, thank you so much for watching. Remember to invest early and often, and to boldly and courageously go after the life that you want. I'll talk to you again soon.